Welcome back. If you own REIT, this video could save you thousands of dollars in losses or help you avoid a dividend cut you never saw coming. We're talking about a $156 million property tax dispute that Equity Residential buried in their 10K filing, and this same strategy is being deployed across the entire residential REIT sector right now. Let me start with the core problem. When you look at a REIT dividend yield, you're looking at a number that's supposed to represent the cash being returned to shareholders. But what happens when a significant portion of that yield is based on tax liabilities that haven't actually been resolved? That's the situation we're examining today. Equity Residential's $156 tax dispute. The specifics. In Equity Residential's most recent 10K filing, buried in footnote 11, income taxes, there's a disclosure about property tax appeals totaling approximately $156 million. Here's what makes this significant. This isn't some small accounting adjustment. For context, Equity Residential's annual dividend payout to common shareholders in 2023 was approximately $2.4 billion. This $156 million represents about 5% of their annual dividend payment, or more directly, it represents real money that could either flow to shareholders or be consumed by tax liabilities. The disclosure states that the company is involved in property tax appeals across multiple jurisdictions, primarily in California, Illinois, and New York. These aren't arbitrary disputes. Property assessments in these states have been aggressively appealed by REIT based on arguments that market rents have declined, or that income-based valuation methods should be applied rather than comparable sales methods. Here's the mechanics. When a REIT believes their property is overassessed for tax purposes, they file an appeal. During the appeal process, which can take 3 to 7 years, they may accrue a liability on their balance sheet for the difference between what they are currently paying and what they might ultimately owe if they lose. But here's the trick. Many REITs structure these disclosures in a way that makes the ultimate outcome ambiguous to investors. The CAP rate inflation mechanism. Why do REIT care so much about property tax appeals? Because property taxes directly impact what's called the net operating income, or NOI, of a property. And NOI is the foundation for calculating cap rates, the capitalization rates that investors use to value real estate. Let me walk you through a concrete example. Imagine Equity Residential owns an apartment building in Chicago with annual gross rental income of $5 million. The property taxes on that building are $400,000 per year. Their NOI calculation would be $5 million minus operating expenses of $2 million minus $400,000 in property taxes equals $6 million NOI. If this property is valued at $52 million, that's a 5% cap rate. Now imagine they successfully appeal and reduce property taxes to $300,000. Suddenly that same property shows $7 million in NOI on the same $52 million valuation. Now it's a 19% cap rate. The building hasn't improved, the rents haven't increased, but the cap rate went up by 38 basis points purely through a tax reduction. Here's the problem for investors. When management reports FFO, funds from operations, or FO, adjusted funds from operations, the metrics used to justify dividend increases, they often include the benefits of tax reductions before those appeals are finalized. This front-loads earnings recognition. The sensitivity math, your real exposure. Let's calculate what this means for you personally. Say you own a $200,000 position in Equity Residential or a similar residential REIT purchased for its 5% dividend yield. That $200,000 position pays you $9,000 annually in dividends. Now Equity Residential has $156 million in disputed property tax liabilities. Their portfolio consists of approximately 318,000 apartment units across the United States. That works out to roughly $490,000 in disputed tax per unit. If property taxes are typically 8-12% of operating expenses, and Equity's operating expense ratio is roughly 35% of gross revenue, then property taxes represent maybe 3-4% of gross revenues. If they lose these appeals, all of them, that could impact annual NOI by roughly $156 million across the entire portfolio. Equity's total annual NOI is approximately $2 billion. So we're looking at a potential 9% impact to NOI. On a $200,000 position, that's approximately $88 of annual dividend impact in the worst-case scenario. But here's where it gets worse. If losses mount, REIT don't immediately cut dividends, they reduce capital expenditure guidance and reduce the pace of property acquisitions. This compounds over time. In a moderate scenario where they lose 40% of their appeals, that's $62 million in NOI pressure, or roughly $35-40 annual dividend impact on your $200,000 position. However, the bigger issue is yield compression. When dividend safety comes into question, REIT valuations typically contract by 5-15% in the market. On a $200,000 position, that's a $10,000 to $30,000 loss in market value. Combined with the dividend reduction, you could be looking at $45,000 to $70,000 in total losses, roughly 22–35% of your capital. Why this is systematic across the sector. Equity residential isn't alone. Avalon Bay Communities, UMH Properties and others have similar property tax appeals outstanding. According to a 2023 analysis by NAREIT, National Association of Real Estate Investment Trusts, approximately 23% of publicly traded residential REIT had outstanding property tax disputes exceeding $50 million. The sector-wide exposure is estimated at $3.2 billion. What's concerning is the pattern. Property tax appeals spike during periods when assessed values are rising but actual property values, based on cap rate metrics, have stalled or declined. This creates a window where management can argue their properties are overvalued for tax purposes. The appeals are technically legitimate, but the practice of recognizing the benefits before finalization creates accounting arbitrage. For example, in 2021–2022, when cap rates on apartment buildings compressed to historic lows due to massive demand and low interest rates, we saw a wave of property tax appeals filed by residential REIT. The argument was straightforward. Yes, we can charge higher rents due to scarcity, but our properties shouldn't be taxed as if they are worth $400,000 per unit when comparable recent sales suggest $380,000. In some cases they're right, but in others they're using the appeals process as a timing tool to front-load earnings. The SEC Transparency Gap, here's what's most troubling. The SEC hasn't created a standardized disclosure requirement for contested tax liabilities in the REIT space. Item 103 of SEC Regulation SK requires disclosure of material legal proceedings, but it's left to company judgment whether property tax appeals qualify as material in a way that requires separate highlighting. Compare this to how technology companies are required to disclose tax valuation allowances or uncertain tax positions under ASC 740. There's no equivalent standard for real estate assets. This creates an information asymmetry where sophisticated investors who read 10K footnotes discover these issues, while retail investors simply see a 4–5% dividend yield and assume it's sustainable. A 2022 analysis by the Brookings Institution found that tax assessment practices across states vary wildly, and that residential properties in particular have been subject to less consistent assessment than commercial real estate. This creates exactly the kind of ambiguity that enables REIT to exploit disclosure gaps. The counter-argument and nuance. To be fair, not all property tax appeals are improper. Some genuinely represent situations where properties were overassessed. In New Jersey, for example, a series of high-profile reassessments found that many residential apartment buildings had been assessed at 105–115% of fair market value. REIT winning appeals, they weren't gaming the system, they were correcting clear errors. Additionally, property tax reduction can reflect legitimate business improvements. If a REIT invested $50 million in capital improvements at a property and successfully argued for a reassessment that reduced taxes, that's a real improvement to asset quality. The issue isn't that appeals exist, it's that the earnings recognition timing relative to appeal resolution creates uncertainty that isn't adequately reflected in dividend yield calculations. What this means for your portfolio. If you own diversified REIT ETFs or funds, you're likely exposed to this issue across 4–8 holdings. If you own individual REIT positions, you need to first review the 10K footnotes specifically for income taxes, legal proceedings, and commitments and contingencies. Look for any mention of property tax appeals or assessments. Quantify the total amount. Second, calculate the exposure per unit or per share. A $100 million exposure matters differently for a 200,000 unit operator versus a 50,000 unit operator. Third, cross-reference property tax appeals with recent FFO guidance. If management raised a faux guidance while simultaneously disclosing large tax disputes, that's a red flag. Finally, monitor state tax board rulings. Many of these appeals are being decided now. Watching the outcomes will give you insight into whether your REIT estimates are realistic or optimistic. The bottom line,